Hello everyone, today is March 20th, 2019. My name is John Lawrence and this is the Fluffy Chicken Podcast. And today is a very important day for everyone, whether they know it or not, because most people on Main Street do not pay attention to Wall Street. And no blame to them because most people are busy raising their family, paying bills, and a lot of people don't have the interest in it. But unfortunately, what happens on Wall Street has a great effect on Main Street. And over time, it seems that more and more and more of that effect from Wall Street is exacerbating into Main Street. So today is an important day because Fed Chairman Jerome Powell went out and stated that QT will cease and desist September of 2019. QT stands for quantitative tightening, and most people do not know what quantitative tightening is or what it stands for. And it really is the execution of a plan that began in 2008. And the plan started in 2008 because we had a financial crisis. We had the Great Recession. And that Great Recession was so bad that it forced upon these economic measures that have never been tested before. This is the first time in human history that they have been tested, and we really don't know how they're going to play out. The playbook hasn't been written. It's not a certain playbook because it's just guesses. And it began in 2008 because things could have gotten so bad that Treasury Secretary, Fed Chairman, Fed governors have talked about how the ATMs were going to stop working in 3 days. It was at that point in September in 2008. So the crisis was real. I mean, could you imagine even 10, 11 years ago in 2008, if you went to an ATM, had a bank account, and you thought you had a balance and you tried to extract money and the ATMs just didn't work? I mean, that's what we were facing. So they were trying to avoid this economic calamity. So they invented these measures and implemented them and did it so trying to also implement confidence into the U.S. economy. And that confidence, it was right away, hoping that people believed the plan. I think the Fed and the Treasury also hoped that the plan would work, because I'm not certain that they actually knew that it would, but it was worth a go anyway because of what they were facing. And that plan began at that time, and it was called quantitative easing. To understand quantitative tightening, which is planned to end in September of 2019, you have to understand what quantitative easing is. Quantitative easing was invented in 2008 for the Fed to create money to purchase bad assets. And what they did was to create money. We don't have printing presses anymore, but what they could do is they could create these bonds because the United States is the world currency and we control our own currency. So the Fed creates these bonds and sells them to the market. As they take all of these bonds, it's this new fresh supply, law of supply and demand. When you enter in all of this new supply in the market, it's going to drive down the price. Now, it's important to understand when it comes to a bond, the price is simply the interest rate. That is the price. So when you enter all of these new bonds, which is created by the Fed, that interest rate goes down. So if it was 3% and new supply comes in, that interest rate now becomes 1%. And our interest rates were driven down to, on the Fed funds rate, to zero. But all these bonds got so low that it becomes easier for companies, for individuals to borrow money. So that quantitative easing, entering the fresh supply of bonds into the bond markets, people can buy them, but because there's so many, that price tag, which is the interest rate, goes down. All of a sudden, it's new liquidity into the market. Now, the money that the market spent, whether it's governments or it's individual investors, and buying these bonds, when the public bought those bonds and sent it to the Fed, that liquidity was then used to purchase the bad assets on the bank's balance sheets. Okay, it could have been the bad housing, it could have been derivatives. So all of a sudden, the banks are now almost made whole again because the Fed became their insurance, their backstop, because the Fed created bonds, sold them to the market, drove down the interest rates, which spurs new economic growth when it's easier to borrow. So that part is the quantitative easing. That's probably the easiest way to understand it. And most people question, well, when we issued all this new liquidity into the market, all this new cash, isn't more cash just going to cause inflation? Well, there's two answers to that. One answer is simply yes, and it did. And by that, you can look at asset classes. So we entered into all this new liquidity in the market. We gave the banks all this money, and it shored up the assets, their bad assets on their balance sheet. And what happened, we see stocks since 2008, they've really tripled. The Dow's tripled. We've seen housing prices go up. So that liquidity went to the asset classes is actually predicted, and the intentions were of the Fed back then by Ben Bernanke. There are several interviews of him talking about how QE, quantitative easing, would do that, and it would boost the asset classes, and in turn that would help turn around the economy because that consumer confidence of having the higher asset classes would push spending. And that's really a huge problem because people argue all the time about the wealth gap in the United States and whether it's taxes, Republican versus Democrat, when nobody simply just understands quantitative easing and how that's a huge driver of that problem. But it's simply easier, I think, to blame a political faction party and join a team than it is to understand economic policy from Main Street looking at Wall Street. So that in itself is something to consider. It's a huge scenario. That's an experiment that's been playing for 10 years now. So all of that money has entered into the market. Asset prices have gone up, and has inflation hit Main Street? That's the second part of the question. And that answer is no. Inflation has stayed at that target of 2% year over year. So the reason why is because all of that liquidity that the Fed gave to the banks to shore up those bad assets, that liquidity, once shored up, stayed there. The banks kept that money as a higher capital reserve, and the Fed actually paid them an interest rate better than the market could have paid the banks, because all of those bonds the Fed put out in the market drove the bond rates down. So it's really a manipulated market. That's not a conspiracy theory. It's fact. It sounds a little crazy, but that's what happened. That's what transpired, and it was an organized plan by the Fed. And then, just like almost like a war, there has to be an exit strategy, because this is really what it is. We need an exit strategy, and that exit strategy is QT. And again, that is an experiment that hasn't played out before. But the idea is that after '09, we were going to be done with QE. But we simply weren't out of the woods yet. So in 2011, we did another round of QE once more. And we did a third round, which was debated on if we needed or not, of more quantitative easing in 2015, 2016. And that was the last one, said the Fed. And then we would take a pause, of which we did. We did not raise interest rates, which is the first tool really the Fed has to control the economic downturns, is the interest rate. And then this second one is the second one we had to create. Had to is debatable. But quantitative easing, also known as the balance sheet tool, it's the same thing. So that's the second tool that was introduced because simply controlling the Fed funds rate, the interest rate, wasn't enough on that short term. So we have entered into this new phase that we have embarked on, I think, for a year and a half now, of quantitative tightening. And so just as the Fed, with quantitative easing, introduced bonds to the market, now the Fed is pulling back the bonds out of the market. They're pulling liquidity out, and they're simply just destroying them. So they're pulling the cash out. That's all it is. It's not that they burn money. They just take the bonds back, they buy them back, and it's over. They're just extracting the liquidity, and they're not entering new bonds back into the market. As you extract that liquidity, now it's more difficult to lend because there's less U.S. dollars, there's less treasuries out there. When there's less out there, supply and demand, all of a sudden the interest rates want to start rising because there's more of a bid for that treasury. The problem then becomes, as interest rates start to rise, it affects the debt that we accumulated over the last 10 years. Because when you have interest rates so low like we did over the last 10 years to spur growth, well, people make poor decisions. All of a sudden you have a corporate debt, you have student loan debt, you have personal debt, you have the federal debt. All of this debt amasses because it's so easy to borrow on a 1% interest rate, which is less than inflation at 2%. So people take on all this debt and they're saddled with it and they're not ready to pay it off yet. And all of a sudden we start extracting liquidity out. The bonds start having a higher interest rate, and that debt that has that fluctuating interest rate starts to rise. And as it rises, there's not enough economic growth, organic economic growth, to pay that debt back, because we made so many poor decisions where companies were going out and borrowing money just to simply buy back shares or boost their dividend. Consumers got used to that easy liquidity. They started buying more than they could. Auto loans, that's record high defaults. So people got hooked on the easy money, and now we're in this limbo phase where we cannot keep the interest rates so low because people will keep accumulating debt, but we also cannot continue QT, of which we already said, the Fed did, that we will stop in September of 2019, because we cannot keep extracting liquidity because the interest rates will go too high. So that leaves you in a corner. The Fed was put in this corner. I don't think they know what to do, so all they're doing is punting. They're saying they're stopping quantitative easing because of the global economic outlook that looks so bleak. They're saying that China has problems, of which they do because we're in a trade war, which really to me isn't as bad as our scenario with this QE, QT nonsense. And then you have Europe that's slow. So the Fed does have a little window to punt and say that we are stopping QT because of the outside pressures is going to drag down our economy, and we just want to take a pause and be patient and wait for that to clear up, and then we can resume our normal economic prosperity that we were having in the United States, when really it was just boosted by the cheap money, and it was all of this debt that was creating this prosperity, which is not sustainable. That's simply just a bubble. I mean, a bubble is really just easy money flowing into a sector and that boosts asset classes. And eventually it gets pricked, it collapses, and we've seen more bubbles just build and burst since 2000. We had the dot-com crash, we had the '08 financial crisis, and we are ready. We are looking for another one. It's around the corner. I have to take I don't want to take the victory lap, but I just want to prove that I had been suspecting that September 2019 was going to be a problem all along. I wrote on streetsmarteconomics.com one of my earlier articles in August of 2018 that September of 2019 was going to be a problem. So I've already put it out there, because there is no way that with the debt that we have in the United States that's ballooning, especially with the Trump tax cuts, we cannot fund what we are doing. It makes no sense. And then on top of that, that quantitative easing going simultaneously as China and Europe were entering problems, there's no way that we could afford to try and even sell those bonds, because nobody was going to buy them because of all of the problems abroad. The interest rates would go up. We have too much debt. So the Fed had to take that off the table. That's what they did. And since then, you'll see that the price of gold since I think this morning has risen $20. That might be about 2 points, about 2% is up. Because as we start to devalue the dollar, which is all we were doing with quantitative easing and then halting quantitative tightening, we are simply entering this phase of just devaluing our own dollar, which is a problem, because then the imports that are coming in, we don't have a strong enough dollar to gain more for what we need, because we don't produce anything anymore. I'm not sure what we're going to do, but I do know that it's simply a problem. I don't know how we're going to get out of it. I do have a clue of what we're going to end up doing, and I don't think it's going to be paying our debts or defaulting on our debts. I think we will, in September 2019, of course, stop quantitative tightening, and then we may have a brief pause. But as a recession, of which I predict will come on, we will have to find a way out. And as the Fed has become politicized, that only way out will be the second tool. The first tool being the Fed funds rate, cutting that rate down to zero, which won't be enough. That used to be the only tool in the Fed's repertoire. We will then go back to the balance sheet, also known as quantitative easing, and we will start printing money once again, which is just a figure of speech. It's not really printing money. We will start issuing a mass amount of bonds out into the world, probably more than we have ever done before. And as we do that, we will be destroying the dollar as we are just sending more US dollars all over the world. There will be less of a grab for our dollar. And if you don't think it's possible for the United States to lose its position as the U.S. currency leader, that's a little crazy, because countries have done it all before. Denmark had their position. Great Britain had their position. We were on the gold standard. So the United States is not impenetrable. We do not have a bulletproof vest towards recessions, and we are certainly vulnerable, more vulnerable now than ever. So these are real problems, and I believe that in the first quarter of 2020, we will start quantitative easing. Our plan all along in 2008 was to start quantitative easing, which was like training wheels for an economy, and it was going to guide us along, and eventually we were going to strip them off with quantitative tightening, and then once again the American economy would ride along rosy and off into the future. But that's simply never going to happen. And here we are now. We have stopped the quantitative easing, which was supposed to run the balance sheet down to where we began, which the Fed had on their balance sheet at that point, about $700 billion. We, at the end of the last round of quantitative easing, had $4.5 trillion. I think we're somewhere just beneath $4 trillion right now. Maybe it's $3.5 trillion. So we never got close to our target rundown rate, and we are stopping in September. Maybe we'll be at $3 trillion. And of course, I certainly believe that in the fourth quarter of 2019 or the first quarter of 2020, we will cut the interest rates and we will be back again to quantitative easing. And when that happens, the dollar will deteriorate. And as you can see, the reaction on the only class out there to invest in will take off. Right now, there are bubbles in housing. There are bubbles in stocks. I mean, it is all over the place. EM has an opportunity, but the one sector that makes any sense at all are the metal sector. You have copper, you have gold, you have silver. Those are the only ones being punished, because if you understand the relationship in commodities, when there is a strong dollar, it suppresses things like precious metals, copper, base metals. That's the way it works because we are the lead currency. So as the US dollar, you can track the US index. As we lose our purchasing power because we launch another round of QE, throwing more dollars into circulation, our US dollar will be worth less. As it's worth less, the relationship hedged against gold, silver, copper, precious metals will rise. And that really is the place to be. If anybody thinks that we're going to have another 10 years of prosperity, they're out of their minds, because today was actually the greatest example of how we have peaked on the stock market within the Dow. If you looked at it today, Trump was talking about the deal negotiations with China that really don't even exist, but he's still talking about them anyway. And finally, he may have been the most honest he has been for months now about it, that a deal is still far, far away, because in fact, I don't think that China really needs a deal. They are in the business of stealing IP. That's the only way to carry out their plans, because to do it organically, it just doesn't, the timeline doesn't make sense. So Trump was talking about how simply we are months away, we are not near a deal, and he was talking very negatively on it. And the market reacted by dropping I think 170 on the Dow. And as it went down, and then the Fed chairman came out and spoke, he gave what was normally a bullish sentiment for the stock market, that he was going to stop interest rates, which is always bullish for the stock market, and that quantitative tightening would also stop. That easy money has always boosted asset classes in the past. And today is the first time that type of rhetoric actually stopped the stock market from rising, and we finished down today. I haven't looked at it, but I know it was down. Maybe it was 170 points at the end of it. But it's the first time. So the fact that the tax cuts are done with Trump, the fact that easy money is not enticing the stock market to rise means we're done. We have found the peak in this bull market. March 20th, 2019 is the day that we are about to begin the descent back into bear territory because there's nothing left. You don't have any more tax cuts. You don't have any more Fed posturing. It's over. So it really is the most important day for the probably for the rest of 2019. This will be the day it looks upon. I am sure that maybe in December or November, when we embark on this recession, that more important days will outshadow this one. But this one needs to be acknowledged, bookmarked, and it's real important. But unfortunately, Main Street is not going to know about it until it's a little bit too late. But anyway, today, thank you for listening. My name is John Lawrence. This is the Fluffy Chicken Podcast, and have a nice day. Bye.